Hi, so in this session we're going to be talking about the US banking crisis. We're going to look at what was the cause of it, what's going to happen going forward, what the Fed has done regarding trying to solve the US banking crisis, and also the major cover-up of projecting the message to the public that all the banks are secure. So essentially the US banking crisis, as we're all aware, especially people of my age or even the younger people are aware, that back in 2008, 2010, banks in the US crashed due to the credit default swaps, which was the subprime mortgage market. They just lent too much good money to the wrong people. As a result of that, those wrong people didn't repay their mortgages and essentially the banks went bust. There's a lot more into it than that. I could elaborate a lot more. Some banks went bust. A lot of banks contracted and were forced to amalgamate, and then came out the US solution, or the Fed or the US Treasury came out with a solution of let's do some quantitative easing. Quantitative easing is a nice polite word for printing money, and that's essentially what they did. They printed billions and hundreds of billions of dollars to give to the failing banking system. Many banks, Bear Stearns, Lehman's, simply closed their doors, got unlisted from the stock market and went bankrupt. What the Fed and the US Treasury did then is they wanted to take all of the poisoned assets away from the banks, so they would then take the toxic debt, park it elsewhere, and then the banks would be completely clear of any particular bad debt. What does that mean? It's quite simple. Let's say you're running a business and that business has 100 customers, and out of those 100 customers, most of them when you start the business are good customers, but as you go and develop your business, you start getting 40-50% of your customers simply aren't paying the bills or aren't paying their way. So you would eventually either have to raise the price for existing customers, or you could close the doors because there's not enough revenue coming in. Along comes the US Fed and says to ABC, we're going to take away the 50% bad debt that you've got as a result of those customers not paying. Don't worry about those. We're going to compensate you and give you money for those 50% of bad debt. And as a result of that, your business is going to be more healthy. And that's exactly what they did in regards to the US banks back in 2009, 2010 onwards. They took the bad debt, they printed a load of money, gave it to the banks in order that the banks could then survive with the new money coming in, because the banks were essentially bankrupt. And that was the case of quantitative easing, and that's what quantitative easing was. If we fast forward all the way to the pandemic, at this stage the banks, JP Morgan, Goldman Sachs, Bank of America, Merrill Lynch, have all moved up and now are in pretty strong position. But those are the top tier banks. What we're looking at is the lower tier banks, or called the US regional banks. So the US regional banks are the ones where you go and do your business, where you do your checking, deposits, savings. That's the US regional banks. And there's around about 4,600 regional banks in the US. A lot of them are on the verge of going bust. Why are on the verge of going bust? Quite simple. Back in the pre-pandemic, when US bonds where prices were high, the yield paid on that bond was low. As a result of that, the US regional banks would go and invest in bonds because bonds are equivalent to cash. And by bonds being equivalent to cash, what essentially happens is that the US regional banks could then convert those bonds into cash when needed. The yield on those, which is the interest rate paid on the US Treasury, was low. Low yield, high price. However, coming into the pandemic, what you had is a load of people were given hundreds of millions of dollars or billions of dollars was printed again, given away by the US, by the UK, by the Europeans, etc. But talking about the US specifically, that money was then paid out to the families. The families went to the banks and deposited that money, or the money was deposited direct into their bank account. Remember, during the pandemic, there was no pubs, no holidays, no hotels, no vacations, nothing. So therefore, nothing could be spent. There was only a bit of online business that was being done at the time. So that money in the individual's account was accumulating with the bank. So the bank had now a flush of money. In fact, things were so good at the time that credit card debts were being completely paid off because the government was sending so much money to the individuals that were taking that money and paying off the debts, which is great. Therefore, they were saving about 30% of their take-home pay during the pandemic, which was terrific. All that changed as we came out of the lockdown, and then what happened was interest rates began to rise. Why? Because of inflation. Inflation was caused by the lockdown, having huge amounts of money available to spend with nowhere to spend it. And as a result of that, when the lockdown was over, people came out and spent the money. There wasn't the supply of goods. People demanded high-level goods, Louis Vuitton, Gucci, Rolex, cars, whatever. Prices went through the roof as a result of the high demand, low supply, and therefore what you had essentially was inflation, or the start of inflation. If you go into 2022, you had inflation. Then Janet Yellen, who was then US Treasury Secretary, said that inflation was transitory, which was it's only going to be temporary. Still 2 years later, 2.5 years later, we're still in a high inflation regime, and therefore that's not going to go away. It's going to continue for the next 10 years. That's my opinion. So moving on to where we were now with a lot of money, low supply, we've got a high demand, low supply, prices move up. As prices move up and interest rates move up, the Fed, central banks in the US, UK, Europe, Australia, Canada, around the world began to raise interest rates. As they raise interest rates, then bond prices fall because people would move their money out of bonds and into cash. As a result of the bond values falling, those regional banks had a net asset value drop. So the value of those banks was dropping. Therefore, the liquidity was dropping, and therefore you had an immediate crisis in terms of banks like Silvergate, Silicon Valley, First Republic, just to name but a few. And therefore, what happened was essentially those banks went bust because the value of their bonds had gone down, the value of their cash reserves essentially had gone down, and they didn't have the money to meet up or match up to the demands of the depositors to withdraw their money. Moving forward, we're in the same situation. Still got the regional banks in terrible, shocking condition. The most recent was the New York Community Bank, which just got $1 billion injection from a hedge fund, and of course the head of the hedge fund was one of the ex-members of the Federal Reserve, and he was given the nod to go and buy or invest in that bank to stop that bank going bust, which would mean there'd be a run on the banks. The New York Community Bank, was essentially Bancorp, was going bankrupt, but then got $1 billion injection about 4 months ago. Surprise, surprise, unusual, but that's what happens. So the other banks which are scattered across the US are all in the same predicament. They don't have the money because their net asset value is falling. Therefore, there's going to be a bank crisis. In addition to that, you've got $929 billion worth of commercial loans that have to be repaid this year, and those borrowers don't have the money to repay those loans. Who's going to fork out that money? It's going to be the regional banks, which is going to go to the US Treasury and get another massive cash injection, or essentially go bust. So the US regional banks is the second tier, lower tier level banks. They're the ones that are likely to go bust near term. As a result of that, that will cause a knock-on major banking crisis. You're going to have a second tier US regional banking crisis, which will knock on to the big banks of Citibank, Morgan Stanley, Goldman Sachs, JP Morgan, Bank of America, Merrill Lynch, etc., etc., etc. So those banks are essentially in the firing line to go or have some sort of major banking crisis, and another massive bailout by the US Treasury and the Fed Reserve is on the cards. How will that impact Europe and the UK? Well, the UK, essentially, the banks were already bought out by the UK government back in 2009, 2010, or were merged with other big banks. So the crisis there is not as intense or severe. In Europe, you've got major banks like Deutsche Bank and Bank Paribas Capital Markets. They are Bank Paribas, BNP, they are in serious trouble, and they're also likely to go or have to be bailed out minimum or go bust. But the probability is they'll be bailed out because Deutsche Bank's debt is bigger than the German government, and that is for a separate lesson. Remember, I'm running workshops regularly. Next one is on the 5th of May. That's going to be on beginner's introduction to options. I'm also running workshops on the Middle East, on oil, on gold, on stocks, on shares, on bonds, the whole array. So if you want to join those workshops, all you have to do is send a message, comment workshop. We also run a mentorship group, VIP mentorship group, which you can join as well. That gives you one-on-ones, access to 6 banking analysts. I've also got some books out on Amazon that you can also purchase to help you with your trading and investments. That's it for now. Catch you later.